Welcome all, and thank you for joining today's Service Department News webinar. Today we're going to be talking about chasing supply, inventory, pipeline, the how, where, and why. And a little anecdote from myself to kick off with. The reason why we are hosting today's webinar on today's topic is that at the front end of this year, had quite a few readers write in asking myself if I knew any figures, any recent stats or data around pipelines coming into London or further afield. So I hope today's webinar puts some meat on the bone for you and provides some context. So who am I? Firstly, I'm Eloise Hanson. I'm the editor here at Service Department News, and we are an online trade publication covering the global service department, apart hotel, and extended stay sectors. You may have seen in the intro video, we are hosting the 11th Annual Service Department Awards here in London on the 11th of May. Judging is currently in process. We are going to be revealing our shortlists for those awards as of next week. So thank you to the hundreds of companies that are taking the time to enter this year. Whilst we wait and eagerly await those shortlists, I would like to flag that voting is actually currently open for 4 of our categories. We have a Rising Star, Industry Inspiration, Team of the Year, and Best in Room Supplier. My colleagues will pop the link to vote for those categories in the chat. We would absolutely love you guys to get involved. Your vote truly counts in shaping what excellence looks like. And here on your screen are the 4 categories that you can vote for. Deadline to vote is actually tomorrow, so please do take the time. So a brief overview of how today's webinar is going to run. We'll spend around 45 minutes in conversation with our panelists today. If you do have any urgent questions for our speakers, do get in touch as soon as you can, really. You can submit your questions using the Q&A function at the bottom of your screen, and I will get round to asking those questions where I can. Today's webinar is being recorded. Every single registrant will receive a copy of the recording along with a written summary of the key discussion points. And if you do have time, a short survey will pop up on your screen when you exit this webinar. We're always looking to improve, and any feedback is super valuable. So I'm just going to provide some context again as to why we're here. And here on your screens are 3 very different examples of how owners and operators are growing their inventory. So moving from left to right, MCR Property Group, which has a number of PBSA investments, has acquired 3 service department properties in central London, formerly operated under Mackenbell. And it marks MCR's entry into the hospitality sector, and who plan to relaunch these assets under a new independent lifestyle collection brand. The middle story on your screens, we have an office to apart hotel conversion. The former Beaufort House in Belfast is being transformed into a 98-key Stay City property, and this also marks Stay City's first project in Northern Ireland. And finally, on this slide, Beyond Apartments has added 3 sites to its portfolio, and I believe that these assets were former Sonder properties, showing that where there's disruption, there is also opportunity. On the next slide, here's some stories of what our speakers have been up to recently. And hot off the press, Savills has just released its European Serviced Apartment report. And I won't steal Richard's thunder because we are going to hear from him later on today. But just a headline stat for you. It shows that the sector has recorded approximately 1.2 billion euros of transaction volumes in 2025. And that counts for around 5% of total hospitality investment. Over in the US, a new entrant, Landingplace Hotels, which owns the extended stay brand Landingplace Suites, has launched an ownership platform designed to acquire and convert existing hotels into Landingplace branded properties. Once again, we'll be hearing from Jeremy very shortly. And Limehome has also reported that repeat partnerships with landlords and investors across Europe account for nearly 50% of its recent deal pipeline. Now, I believe that most signings are repositioning projects, although there are some new development deals forming part of that pipeline. So, Joseph, please correct me if I'm wrong here. But on that note, why don't we meet our speakers? Let's hear from them directly. And we will kick off with Joseph. A short introduction, please, and do tell me off if I have got my facts wrong there.
Hello. Thanks for having me. I'm Joseph. I'm this co-CEO and co-founder of Limehome. We are a tech-enabled hospitality operator across Europe, headquartered in Munich, Madrid, and Milan. And we currently have around 12,500 units under contract and are basically growing 40% year over year.
Nice one. Thanks, Joseph. Richard, let's come to you next, please. Welcome.
Hi, very good afternoon, Eloise and all. So, look, sitting here in Savills HQ in London, I'm a director in the transaction teams, hotel capital markets, effectively inclusive of service departments, one of my specialist subjects, running deals in the UK and across Northern Europe.
Thank you, Richard. And Jeremy, over to you.
Hi, my name's Jeremy Bratcher. I'm CEO and co-founder of Landingplace Hotels. I'm sitting across the pond in the United States in South Carolina. My background's primarily on the operations and franchising side. And today we're building a hotel franchising platform focused on extended stay and select service hotels. Alongside that, as Eloise mentioned just a minute ago, we've also launched an ownership platform called Landingplace Holdings. And with that platform, we're acquiring and converting existing assets. So we're looking at supply from both operating and investment perspectives.
Thanks, Jeremy. And to flag here, all the LinkedIn profiles of our speakers have been popped into the chat. So I do encourage you all to connect directly, carry on today's conversation long after today's webinar has finished. Right, so let's dive in. And I'm actually going to come to each of you, and I'm going to come to each of you as you appear on my screen. And I would like you to share in one sentence and explain why, where each of you are seeing the biggest friction point today in unlocking new supply. Is it the sourcing? Is it the financing? Or is it that delivery? Perhaps I have missed something off the list there. Jeremy, let's come to yourself first, and then we'll hear from the others.
Yeah, if I can take two sentences instead of one.
Sure.
There's a saying, there's no bad weather, only bad gear. And I think for this conversation, that applies here. There's really no lack of real estate and supply. What we're seeing is that it's about having the right operating model and capital structure to make it work. And if you're creative enough, you can make a deal happen.
Mm-hmm. Richard, what do you think?
Yeah, so look, I couldn't agree more with Jeremy, but like fundamentally there is capital available. Yeah, I mean we're seeing that in the deal volume that you suggested earlier, which is an absolutely right stat there. 1.2 billion traded last year, out of nearly 25 across Europe hospitality. But it's and opportunities are there. We're seeing that in your pre comments there around MCR and others, and Joseph's having some great traction across Europe. But it's the delivery, it's getting the structure right to get these projects off the ground fundamentally.
Thanks, Richard. And Joseph, your thoughts, please.
Yeah, it's as the other two already said. It's never just one factor, but if I have to pick one, I would actually go for sourcing, because I believe in most of our markets, at least over the last 2 years, operating costs increases have outpaced ADR growth. And as a result, I think the window of deals that actually hit the return thresholds like we need and also the investors need is definitely narrower than before. And I also don't see a major change there. I think with what we see in the world at the moment, construction costs will further rise and will also push up the rents or the yields landlords need to make a development or conversion like viable. So I think the gap between what the owner needs and what an operator can sustainably pay has rather widened than getting smaller. So I think it's in the end the sourcing, but of course the financing costs play a role, and also the delivery is important here.
Mm-hmm. Coming back to Richard, if I may now, when it comes to those, so building off what Josef has said, particularly around sort of rising costs, making projects viable, that widening gap between owner expectations and what operators can deliver. What other macro factors are you seeing that's actually impacting the availability of supply right now?
Yeah, it's interesting. I promise not to plug our research reports. You can all have a read, and it's an interesting read, not just because I co-authored it, but with Thomas Emmanuel. But I think it's a great space. I think it comes back to that conviction. It's a really tricky climate today, yeah, for various different reasons, and I'm sure we'll delve into it further. And you'll all, those attending the webinar, will be experiencing it in your day-to-day operations or investing. So it's about that conviction. But I think if we step back and think about service apartments in the bigger context of hospitality across Europe, we looked at 26 gateway cities across Europe. Okay, so that's a huge part of the market. And in that, 8% of supply was service apartments. Okay, so that seems relatively credible for what some perceive this to be a relatively niche space. I have a slightly alternative view where I think this is a stronger space than perhaps some people realize. In terms of pipeline, the pipeline of service apartments against hotels traditionally available today is 12%. So that's obviously a bigger proportion. So overall, the sector is growing by 14% year on year over the next 3 years. This is some big double-digit numbers here in the context of a very challenging viability climate. But I think there's so much more to go. And I think Josef mentioned financing. That's a real challenge today. Yes, there's a lot of capital available on the debt side, but it's just getting the lenders to talk to the operators, to talk to the investors and all of the developers to make something stack up. So it is quite challenging. So that feasibility piece, we're seeing increasing construction costs in terms of delivering that, whether that's the labor or the materials. And so where you have got more expensive projects to deliver, you're putting more pressure on the equity. Now, equity today is working in a very challenging climate. You have a greater opportunity cost of your capital. People are perhaps a little let risk off rather than they were in perhaps 2018, 2019. So working on more operationally proven formats. And this is the challenge and the sort of the chicken and egg for this sector in hospitality is the right thing is pushing into the more tech-enabled platforms, and I'm sure Josef will comment on that. But it's just a little less certain and unknown for some of the traditional investors that are driving the bigger deals out there.
Thanks, Richard. Jeremy, over to you.
Yeah, I couldn't agree with Richard more. You've got the high interest rate environment, especially compared to pre-COVID. Look at the difference from 2019 to where we are today from both interest rate perspective and construction cost. That's really that big headwind on new construction, which is forcing in the industry, especially in the hotel space, to really look at adaptive reuse, office buildings into hotels and apartments, and conversion of brands. And as some of the brands are getting more strict on what they're doing from a conversion perspective, that's opening up the space for some new brands to enter the market. And so, yeah, the headwinds are really making new construction challenging, and we're seeing a lot of interest and momentum in the conversion space in the U.S.
It's probably been one of the biggest trends that we've covered on service department news as well, particularly when it comes to that quick entry to market. Adaptive reuse or conversions still seems to be very, very popular. Jeremy, why don't we stick with you for a moment then? These factors that Richard's highlighted and what you've built on, how is this rolling out in the US? How is it shaping supply, and how is it making the availability of new supply less difficult, more difficult? What's your experience? Give us a bigger picture of what's happening in the US.
Yeah, just as we were talking, the economic headwinds from construction costs and from financing terms is really making it a new world compared to pre-COVID, but that's also creating opportunities to acquire and convert at a basis well below replacement cost. And when we're talking about conversions, that can mean rebranding within hospitality, repositioning extended stay assets, or the adaptive reuse. We're finding some opportunity in assisted living that we're able to reposition into extended stay hotel assets. So really, when you're looking to unlock new supply, it's coming from conversions, and that pipeline of deal flow is really critical. And you've got the customary brokers and that type of deal flow. What we're finding is a friend of a friend who knows someone who has an asset and they don't know what to do with it. That's a great opportunity for us, as well as some older generation assets where some of the bigger brands, they may have a significant change in what their new prototype looks like. And this older asset that might be 20 years old may not fit that model anymore. We see that as an opportunity to acquire well below at a basis well below replacement cost, reposition that asset, and we can squeeze decades of value out of that going forward.
Thanks, Jeremy. And Joseph, to bring this sort of European perspective in here, how are these factors affecting what you're seeing across Europe when it comes to supply and deal flow?
Yeah, I think probably like following up on what Jeremy said, it's pretty much the same in Europe. I would just say probably to even a larger extent. I think what I probably want to point out first is there's unlimited supply out there. There's almost unlimited real estate, because like if we compare our asset class to the office space, where probably 2% of the office space is being rented out there. And like many offices are structurally under pressure, and like many owners are reconsidering to like what they do with office spaces, with other commercial asset classes. So potentially we can source as hospitality, and that's one of the biggest strengths of the service apartment space, that we have a much more like flexible approach to real estate. We can go into conversion projects, we can go into mixed use projects, we can go into smaller assets, because we don't need all the F&B like rooms, common areas and so forth. We're just way more flexible, so we can basically source from a crazily wide range of assets. So in the end, it comes down to the, let's say, financial factors, and like what are the two drivers behind like the attractivity of an asset, and like also the operator which signs a contract or management agreement. It's what are the ADRs and what is the profitability of the operator, and on the other hand, because it basically determines the rent they can pay on, and on the other hand, it's basically inflation. So ADR is heavily linked to GDP growth, and actually way more than most people actually realize. If you have 3% GDP growth, it's probably like 3, 4, 5% ADR growth. If you have zero growth, ADRs rather go down. And inflation, with a delay of 1 year, usually directly results into cost increases. So in the end, real estate markets are usually pretty efficient, because there are tons of operators competing for deals. There are multiple assets available. It just needs to work out. And I think in looking back also probably 2-3 years, like I personally believe we are probably one of the most efficient operators out there in the market, and we potentially could pay quite attractive rents. So basically almost every asset we got, which was somehow attractive from a location perspective, we could sign like 3 years ago. We could have signed 3 years ago. It's quite different nowadays, with 50% higher construction costs. The operating costs for most hotels, for us a bit less, increased probably by 50% since 2019. ADRs have not increased by 50%. In Germany, it might be 20%. UK might be 25%. In Southern European markets, actually sometimes 100%. So there you can still make extremely good money. But in the end, it just needs to work out. And currently in Germany, the Netherlands, UK, it has become quite tough. So when we had 90% of feasibility of a deal, now might be 30%. And I think even more so for other operators. So I think that's basically the whole underlying story. What we also see is, especially in the UK, that many operators just want to get a foot on the ground. And they have, I think, lower thresholds when it comes to operating margins. I think for us, it was always key to be close or around 30% property profitability. And we just can't and don't want to underwrite properties which are below. So that limits us a little bit. But there will always be enough supply. And maybe now then I've been speaking already for a bit, but just to close this off, maybe there is so much supply. We have 10 million hotel rooms across Europe. So if you consider 20 years of contract duration, 500,000 of rooms become available. And most of them will not be able to pay the rents which are required now because they have never modernized the operating structures. They will just not be able to pay what's required. And also there's a lot of regulation happening mainly on short-term rentals, which need to get professionalized. So I think there will be almost unlimited supply.
So many points there that I know we're going to touch on throughout today's conversation. So everyone who's tuning in, hold fire because we are going to dissect this even more. Jeremy, your hand is up. Over to you.
Yeah, if I could just expand on Joseph's point there about, the middle of the P&L being compressed. As operating costs continue to rise, wages continue to rise, all of those costs continue to rise, ADR is not keeping up, which only erodes that profit line at the bottom. And, in the extended stay hotel space, the only thing that has changed in the last 30 years is more and more expense. The brands keep adding more and more requirements. The free breakfast that's not free, somebody's got to pay for it, just keeps expanding, and even the expectation of a room cleaning every third day, that is just continuing to erode bottom line. And one thing we're doing, and we're kind of blazing a new trail in the United States extended stay space, is making housekeeping an a la carte option. Now that there's grocery delivery, DoorDash, Grubhub, Uber Eats, all the food delivery services, is that free breakfast even necessary these days? So we're kind of taking a new angle on that, contrary to the last 30 years of extended stay hotels, and saying, let's give everybody more choice. And by doing so, that helps that owner get more of that margin back. And, the response has been dramatic from the franchise community, because to Joseph's point, to underwrite these deals from an investor perspective is only getting more difficult, and something has to change. So we're trying to do our part in helping lead that change. Otherwise, we're going to price ourselves out of doing business.
Thanks, Jeremy. I'm going to bring Richard back into the conversation now to flip it back onto the investor side, investor perspective. And I'm wondering now if my question has actually been phrased wrong, because according to Joseph, there is unlimited supply out there. So investors actually have quite a big choice to choose from. But Richard, is there a mismatch between the investor demand and what is available to invest in right now?
Yeah, I think there is a mismatch, and I agree with Joseph. There is a lot of supply available. I think it's that institutional grade or compliant stock or supply. Where what do I mean by that? I'm talking about sort of fire life safety compliant. I'm talking about it's got the right sort of more commercial licensing rather than residential, perhaps. And I think that's where we have constrained supply, but that's where a lot of the capital wants to buy into. So we did a survey. Talking to 60 global investors last year, like what do they want to be investing in? How are they shifting their global allocations, etc. And what was very interesting was there was an aggregate over 2 billion euros of capital appetite dedicated or interest in the service department of our hotel extended stay space. Now, as we've seen with the 1.2 billion traded last year, there isn't 2 billion of product that you can deliver that amount of equity into, but that's the I suppose, the opportunity for the sector, but we need to deliver more compliant, commercially orientated in the UK setting, but the C1 use class. And so that's the challenge. Because at the moment, we've got highly fragmented ownership, we've got small sort of subscale assets, and we've got inconsistent operational standards as opposed to the scalable platforms, regulatorized and defensible platforms that these more global or pan-regional investors want.
Joseph?
I think, I mean, generally agree. I think what's missing is not necessarily the supply. I think it's the willingness to take the development and licensing risk. Because in the end, if we talk about the existing hotel stock which comes to the market, usually they have a lot of common areas. Usually you need to invest capex, and most operators are not willing to take the capex risk. And sometimes, if you don't know about the regulation in the cities, it can take rather long. So there is a lot of institutional capital to be invested, but no one is capable at the moment, at the current interest rates and the current yields you can achieve, or is willing to take the development risks. And we see a lot of insolvencies, especially in Germany, on the developer side. So that's the piece which is currently missing to unlock the supply.
Richard?
Yeah, and I suppose, look, to layer that on, I think it's that risk, it's that regulation is changing quite quickly across multiple markets. I mean, we're seeing this year Amsterdam bring in that kind of 15-night cap from the 30. So again, that changes it. So if we're looking at that institutional capital keen to deploy, yes, they might be flexible on some of the licensing, but there's so much risk layered into that now because local governments are changing the position quite quickly. Edinburgh, we've seen a huge shift in available short-term rental product over the last 6 years because of the local changes there, which, whilst it's negative from a supply of sort of more residential service department product, it's been an absolute game changer for the more commercially compliant product that's seen the stats on the occupancy changes over that period has been phenomenal. I think going from about 80% to 85, which is way ahead of the sort of hotel product growth in occupancy. So whilst it's a downside risk and some of the local regulation changes, it's an upside from a value protection for sure.
If anyone listening is actually curious to keep abreast of where regulation and licensing is tightening, one of our sister media brands called Short Term Rentals, spelt with a Z, my colleague Priya Kaira, the editor, is pretty hot when it comes to tracking what markets, what's tightening, and what effect that is having on property managers and short-term rental operators, which may now pivot. We might see pivot into a more extended stay product. So my colleagues who are on the call, if we can pop into the link or into the chat, the short-term rentals website, that'll be super. Now, Joseph highlighted that sourcing was actually one of the challenges that we're facing right now. And I just want to do another quick sort of fire round as to where you are all seeing or finding these opportunities today. And quite frankly, how are these deals being sourced? Is it on market? Is it off market? Is it through local partners? How are these opportunities landing across your desk? Joseph, will come to you first, and then we'll hear from the others.
Yeah, I tried to keep it shorter. I think first replying to your intro, around a third of our projects are actually new developments. A third are takeovers, smaller repositionings of hotels, and a third are actually conversions, for instance, from office. And also to make this clear, we, like in the UK, would be C1. In the other countries, we are in the commercial use permit, so we usually have the hotel license. We're not a residential player. And I think also building on what I said before, the problem is less that there is not enough supply. The missing piece is someone who does the required development or the required capex investment. And I think there we have built a very strong base with more than 100 landlords. With quite a few of them, we do multiple deals. They even buy, and then they know we're gonna come in. So we team up quite early. And many of the assets they acquire are actually office buildings, or they are old, distressed, like hotels. And therefore, I would say around 80% of the deals we source, we do not have any professional competition at all. Because, like as said, we team up quite early in the funnel. And I think one of the major advantages is also we have a very, let's say, tech-based operating model, and we have a very high flexibility when it comes to asset types. So we are present already in 150 cities in Europe. We are happy to go to smaller cities and so forth. And this takes us out from most extremely competitive processes, which we usually are also happy to lose, because in most of these, there's always some crazy player being willing to go to, I don't know, even a 1.1, 1.2 rent coverage. And now, as I promised to keep it shorter, it's a lot of repeat partnerships, more than 50% of the deals. We get a lot of inbound deals because we have like bluntly a huge expansion team, which is regionally structured, and every expansion manager is supported by an architect, by construction engineer, so we can support the real estate side quite intensely. And then, of course, we also do new developments with partners, and therefore it always probably will stay in the range 30-30-30 of developments, takeovers, and conversions.
Some of the new developments, or in fact, quite a lot of the new developments that I am seeing, tend to form part of a big master plan or regenerative scheme, or actually has some mixed use elements to it. So it's taking X amount of floors, but there's resi and office as part of said one tower. I'm a big fan of mixed use moving forwards. I think there's a lot of opportunity there.
Yeah.
Richard, what are your thoughts here? What are you seeing from a unlocking supply?
Look, Joseph's spot on around the conversion, so I won't dwell on that. But we as a business have been selling a lot of offices to hotel investors or hotel developers with partners like Limehome and others in tow. So that's tested and proven. I'd probably focus a couple of areas of generational shifts. So we're seeing some as the first generations who've built some of these sort of smaller private hotels, whether it's in the big cities across Europe or some of the smaller seaside locations or resort locations. Perhaps the new generation taking these operational businesses on are less motivated or excited to continue to operate these private independent businesses. Fundamentally, regulations are getting tougher if you're not institutional or you haven't got scale. Payroll's getting more challenging. Minimum wage growth is being pretty strong across most of the European districts. So it's getting more challenging. So I think that's providing opportunity where those investors are looking to sell or come out of the portfolios, or whether they're looking to go away from operating these assets themselves, bringing in operator partners, so the tenant solutions, which I think is actually there's a huge amount of upside there for a lot of operators across Europe. And then also, I suppose I'd highlight, traditionally we tend to see markets where you have net sellers or net buyers. So investors are one or the other. But where we are in the cycle here at the moment in the UK and other key gateway markets, I'd argue we're in a sort of a balanced position where we've got a lot of owners who are selling as well as buying, whether they're right-sizing portfolios, perhaps looking at coming out of the tail because it's just taking up too much management resource to manage the smaller assets, etc. So actually those institutional, those larger global investors are selling as well as buying, creating opportunity for domestic or regional players to come in.
Thanks, Richard. Jeremy, I know you joked at the top end that it was a friend of a cousin of a mum who's giving you the helping you support with these deals. But how are you sourcing opportunities and where are you finding them?
Yeah, we're very fortunate that deal flow, frankly, is not the issue today. Right now, what takes a lot of our time is the filtering and underwriting to determine which of these opportunities is actually worth moving forward. And that's where we're spending a lot of our time right now. Because you've got the normal on-market deals that everyone has access to, and those, in a lot of cases, you're not going to get the basis to make the numbers work. Or make them work dramatically. It's the off market or semi off market, or even like local operators who reach out because they're coming up to a capital event. Their rates resetting and they don't want to stay in the deal and they want to offload that property. And so that's where we're finding the opportunity. Another opportunity we're finding to get the basis that we need is a hotel that may not have a sophisticated operator running the day-to-day. And so when we look at it and say, there's some money left on the table at the top, they're not running it efficiently from an operational perspective. So we can come in, streamline operations, run it more effectively and efficiently to really bring that money to the bottom line. That's where we're seeing some opportunity. Now it's finding the needle in the haystack sometimes for that. And that's where the filtering and underwriting piece is so important. But yeah, really it's the off market and semi off market. And I think Joseph mentioned earlier, it's really relationship based. The relationships you have within the industry and other industry partners that want to see you succeed, and they want to see their friend who has an asset and they might be in a tight spot and they need an out. Putting the two pieces together, and that's where the relationship comes to play. And we're finding that to be very beneficial.
Thank you. I'm going to do another call to the audience that if anyone has any questions for our panelists, now would be the time with 20 minutes on the clock to go. So you have heard it once from me. You're hearing it a second time. Do submit your questions whilst you can. We've touched a little bit on the regulatory and licensing challenges, and I think it would be worthwhile hearing from the operators how that is affecting development pipelines, if at any point perhaps maybe a tightening of restrictions has actually stopped you from entering a particular market before, and how is it, ultimately shaping your market selection, and also what is actually feasible, right? What is actually worthwhile moving forwards with. So Jeremy, let's stick with you for a moment, and then we'll head over to Joseph. What are you seeing in the US when it comes to regulations, licensing, and what works and what doesn't?
Yeah, I've got some colleagues who are doing, they're focused on converting hotels to apartments. And they're finding a lot of regulatory challenges in certain municipalities and cities where they don't want new long-term supply and they want it to remain a hotel. Fortunately, our model, we're staying hotel. We may go from traditional and add kitchens to become extended stay. There's not a lot of regulatory challenge there. What we are seeing is certain states in the US, for example, I was talking to someone yesterday who was some deal flow. It came to us in Los Angeles near the airport, near LAX airport in Los Angeles. And it was just with the way they had minimum wages set there, $38 per hour, no more than X number of rooms, no more than X square feet clean per day. The math just doesn't math. I can't make the deal make sense, even buying at 50% of replacement cost. I'm able to buy the asset at a steal, but because of the way local regulators in that city have wages, and that's outside of union, that's a non-union hotel, and I still can't make the math. That's really part of the regulatory challenges we're seeing in certain states, in certain cities. If you're looking at Atlanta, Georgia, it's completely different. And, you've got two, let's say, comparable cities, opposite sides of the country, and the economics couldn't be more different. And so really the wages is a barrier. And so we're making some changes to our operating model to run more efficiently and to be less labor dependent. And that's giving us some extra opportunity in certain markets. But right now, there's still some markets that the juice isn't worth the squeeze. It's just not worth the headache and the brain cells to try to force that square peg in the round hole. And so we're just diverting our efforts into other places where it makes more sense.
Joseph, what's your experience in Europe?
Yeah, I think you have to differentiate, right? I think first there is a standardized regulation of residential short-term rentals by the European Union. And what basically has happened is every municipality basically needs to run a registry, have to register every unit. They have to properly pay city tax. And in the end, it was the first time that the cities got full transparency. The zoning is still completely up to the city. So how much they want to actually allow for. And then usually if it's a more left-wing government, it goes more towards restrictions. If it's a more, let's say, right-wing, like for instance in Madrid, it opens up a bit, and then there are more options, I would say. But generally, there is a clear tendency towards more regulation of short-term rentals, and what's happening in the end, it makes it harder for mom and pop operators and more beneficial for us because supply will disappear. They don't have the infrastructure, they don't have the reporting systems, they don't have the tech. So the costs of operations become more expensive for them, and they don't have the strategic cost advantage of the past over hotels anymore. A logical consequence, less supply, higher ADRs, right? Higher ADRs in a city, rents go up. And we can observe this like perfectly in Amsterdam. We can observe this in Barcelona. The second piece of regulation, restrictions on commercial licenses. This is rather rare. There is Amsterdam, Barcelona, Valencia, where this obviously has happened. They have quotas on how many hotel rooms you're allowed to have per inhabitants in a district, which is, I think, a good thing. But usually across Europe, there is not much, let's say, structural restrictions on commercial hotel licenses because it's good for the city, it's good for the economy. But generally, we like regulation. It helps us to achieve high ADRs.
Thank you. We have had a question from the audience, and it does tie into something that we've touched on today. So particularly, if I had to take a look at the asset classes that we have talked about, we've over and above service departments, I should say. So we have hotel conversions, we have hotel conversions, office conversions into service departments. And I actually believe it was Jeremy who mentioned that assisted living came through as a potential opportunity. And the question from our audience says, which role or what role does senior living play in your expansion, if any? Perhaps Jeremy, you can take this one as having some insight as to if that product works for your operating model.
Yeah, for sure. Great question. And, it really fits the DNA of what we look for in our extended stay because of the infrastructure that exists. You got larger rooms. They generally all have a kitchenette already. You got some flexible layouts with a studio or a one bedroom. And you've got some common space. It's a very easy conversion from senior living to hotel. The only challenge can be, and it's usually easier going from senior living to hotel than from hotel to multifamily from a zoning perspective. So yeah, we love that idea. The challenge with that is as the individuals born in the 40s, 50s, and 60s are now getting into the age of needing senior living and assisted living. There's not a lot of supply of available senior living to convert. So it's a great idea in theory, and there are some needles in the proverbial haystack. It's just not abundant in supply. But it makes a great conversion opportunity for sure.
Yeah, I bet. Joseph, has that come across your desk at all? Are you exploring any opportunities in the senior living space for conversions?
No. And I think I would elaborate on this very quickly. I think first it's living, and we don't like and want to touch like assets which are in the residential space. That's one. From an operator perspective, I believe the longer the stay gets, the lower is the rent arbitrage you can achieve between real estate costs and the ADRs, daily rates you can achieve. And our strength is clearly on automating short stay processes. So we would not have the same USP unless you really go into like medical care and stuff. Then it gets extremely complex and even harder to automate. So no, senior living doesn't play a role, no, neither on supply nor on basic demand side.
Thank you. Richard, you've been patiently waiting, so I think it's time that we bring you back in here. Looking at underwriting deals, what is it that investors are prioritizing right now?
Well, I certainly prefer this question than the assisted living question. That's for sure. I think some of the locations of some of those are probably a bit more challenging for the commercial sets. In the UK and European setting, I appreciate the US is probably a little bit different, but with Jeremy. But look, underwriting. So look, firstly, regulation. So look, are we looking at residential? Are we looking at, I mean, we've all talked about that. But that's key for the investors because they want to be securing finance and the finance wants the commercial solution. Cash flow durability. So look, are we looking at these big hockey stick kind of growth projections? Is there good benchmarking, the efficiency of the platform, etc.? And that's what Josef's business and others can bring in. And then CapEx. So I think we're certainly a bit risk off with CapEx at the moment and investors. And so they're perhaps being a bit more conservative in the underwriting. Apologies, I've got something on my eye, but I'll carry on. So a bit more conservative, which is paring back some of the appetite and the ability to really push pricing. And then scalability. So the exit opportunity. Is there an exit on a single asset? Is it scalability from a cluster benefits? But where is the exit? So absolutely certainty to help drive a solution there. So all in all, there's quite a lot for investors to consider there.
And staying with you for a moment, Richard, we've talked about the high cost of capital, high cost of constructions, and how that is impacting what we can or can't develop and future pipelines. How is this changing what is actually getting financed? And particularly on the lender side, how are they responding? And of course, happy to hear the operators' views on this when it comes to working with banks and lenders in terms of funding projects. But firstly, Richard, what are you seeing?
Sure. Well, look, I think the lenders are favourable. I mean, we get a lot of inquiries from our banking clients. So we have a very significant valuation platform across Savills, valuing a lot of service departments of hotels and extended stay product across Europe and globally. And they see the less volatile cash flows that are driven by these businesses and operations, greater margins, better ability to protect against perhaps short-term regulation changes like business rates in the UK, putting more impact and pressure on some of those cash flows. So I think we do see the lenders very, very supportive of the product type. I think it just comes back to scalability and depth of opportunity. Ultimately, these buildings tend to be a little bit smaller than traditional hotels. So the larger lenders who have big books and want to get more capital into the market are focused perhaps on the bigger tickets, which tend to be more transient trading hotels. But certainly the conversation I have with much of the banking community is very favourable on the UK and European level.
Thanks, Richard. Jeremy, what are you seeing?
Yeah, just to add a little bit to what Richard was saying, we're seeing really a stronger focus on downside protection and ability to execute, and a little less reliance on, as Richard mentioned, that hockey stick style growth. You know, that's nice to have, but really we're seeing lenders that want to make sure their downside is protected and that they've got a sponsor and an operator who can actually execute and deliver. That's a little add-on.
100%. Yeah.
And finally, as we wrap up today's conversation, I want to look more to the future now, and talk about where are we going to see this new supply come from and how are we going to create it. I'll stick with Jeremy and then we can move across the panel. What are your thoughts here?
Yeah, just as we've all kind of talked about, I think there's really the new supply is coming from repositioning and conversions rather than new development. There'll always be new development, but you know, I see the bulk of it coming from conversions. And as I think Josef spoke earlier, you know, construction costs are up anywhere conservatively 25% up to 50% versus pre-COVID levels. You've got development timeline. We're tying up capital 24 to 36 months before you ever see the first dollar of cash flow. And it just makes it really difficult to underwrite new construction in a lot of markets. It's not impossible, but it does make it more difficult. So yeah, we're really moving toward the conversion focus. That's where our focus is, and it's not going to be built. It's going to be repositioned. That's our position.
Thanks, Jeremy. Richard, your thoughts, please.
Yeah, so I mean, whilst I don't expect sort of big volume development, I do see a little bit opening up of slightly more creative deal structures to help the new builds, particularly in the London, Parises and other gateway markets there. So bridging finance and the developer operators trying to work together collaboratively to make these things stack up, these projects where feasibility has been a challenge. I think everybody wants to deliver these projects, but it's challenging. But I think it's sort of the majority will come from the sort of smarter reuse, the consolidation, and ultimately operational scale, where the Limehomes and others are hoovering up some really good quality, smaller subscale platforms out there, and working with their partners, existing landlords.
Thanks, Richard. And Joseph, your thoughts, please.
Yeah, I think it's the same source of supply as over the last 2-3 years. It's hotel repositioning at scale. It's one. It's the office to hospitality conversions or commercial to hospitality, which we see a lot, especially mixed use. And then I think depends on the country, but in countries like Spain, Italy, also France, I think we might see a kind of professionalization of informal supply wave. There are a lot of these Airbnb operators, and there it's potentially feasible to go into apartamentos turísticos, like with a proper license. So I think this could be also a wave in these markets, less in the Netherlands or Germany or UK.
Thanks, Joseph. In fact, thanks to all of you, both Jeremy, Richard, and Joseph, for your time and insights today. Just to flag to our audience that, of course, the LinkedIn profiles of our speakers are in the chat, and we are going to keep this webinar open for a couple of minutes at the end to allow our audience members time to follow up on any of the links that we have popped into the chat today. So please do connect, do carry on today's conversation. And I've just got some closing slides to run through before I say our final goodbye. And we did touch on it today, but our next webinar is actually going to be looking at the regulatory market in more detail and looking at how policy shifts are shaping serviced apartments. The link to register for that webinar has been popped into the chat. No cost to register. You can tune in live. You'll get access to the recording and a written summary. That's taking place on June the 11th, and would love to see you there. And if you're interested in working with us, perhaps across our digital events like these webinars, or perhaps our in-person events like the Service Department Awards, do get in touch with my colleague Katie. Her details are on your screen and also in the chat. So that's it from me, a final goodbye. Once again, thank you to our expert speakers today. Really appreciate your time. Enjoy the rest of your days, and I look forward to seeing you again, if not on the 11th of May in London for the ceremony of the Service Department Awards, then I'll definitely see you on June 22nd. Take care, folks. Bye now.
Bye-bye.
At IHM, we believe in the power of connection. We exist to inspire, to inform, and to unite decision makers who are shaping the future of hospitality and real estate. Our why is simple. We believe this industry thrives when people and ideas come together. And we're here to make that happen. So how do we do it? We publish 4 leading multimedia brands, each a trusted voice in its sector. We blend intelligent content, curated events, and a strong community into everything we do, making it easy, accessible, and genuinely useful. From online engagement to face-to-face connection, we are known for being insightful, collaborative, and refreshingly human. We host world-class events, panel discussions, podcasts, award ceremonies, and webinars. designed to spark ideas, drive conversation, and create impact. With over 62,000 monthly web visitors, 55,000 email subscribers, and 69,000 social media connections. Our reach is deep, and our community is active. We're partnered with the biggest names in hospitality, and we'd love to connect with you. So whether you're looking to grow your visibility, meet the right people, or understand where the market's heading, read, watch, listen, and me. Do it all with IHM.